Good morning, Jags. This is Fahad. Today is Monday, March 8th. Let's get started. In early January, in webinar, we discussed a long, big survey that was done by Morgan Stanley, and the findings of it were quite fascinating. And this survey in early January asked thousands of people, businesses, and for recreational purposes, for leisure travel, what would convince them to start traveling again, and what kind of a spending environment will then emerge? And there was a lot of questions around this that came to our attention, which was quite appealing, where basically the number one answer from everybody was that as vaccines get distributed and COVID trends start to normalize, people want to travel. And it was very straightforward and obvious. And so on January 8th, which is right over here in webinar, we used that survey by Morgan Stanley as a benchmark to then suggest to buy call options in Southwest Airline, LUV. You can see this is the exact snapshot from January 8th. January 8th, taking a look at Southwest Airline chart, January 8th was right over here. And it did quite well, as many JAG clients were positioned into this using February call options at the time, which I then later recommended rolling out to March and further out. You can see the stock went straight up from for about $46, $47 per share to, even after all this market correction that we have seen recently, now around $57 per share. Last Friday was a long tail hammer reversal candle, which would be suggestive of that this correction is likely over in Southwest Airlines. Now, why do I bring this up? I bring this up because I still remain quite bullish on Southwest Airlines. And so this morning I have some new checks to see if the original idea that we discussed in early January with that corporate travel survey from Morgan Stanley is actually panning out now that vaccines are being distributed everywhere and COVID charts are coming down sharply. So here is a chart that comes from Bank of America this morning. And notice carefully over here, these are the leisure and the corporate volumes. The corporate volumes is this blue line, light blue line, and the leisure volumes are these bars. You can see clearly that the leisure is continuing to outperform corporate by a significant margin. In fact, for the week ending February 28th, we are now down only 20% year over year in terms of leisure travel. That's how much we have recovered off the bottom. Remember, we were at the pandemic low. We were almost, 95, 90% down in terms of leisure volumes. Now the corporate travel is also coming back, but leisure volume is down only 20%. If you notice, in every single week, pretty much since the start of the year, there has been gradual improvement in the volumes as vaccines have been distributed. More importantly, if you look at this chart, this has to do with the actual ticket prices, the airfare ticket prices in 2021 so far, almost flat on the session now, on the year now. Remarkable improvement in the ticket prices in the country. This is for all airlines combined. February 28th, as of week ending February 28th, we were practically nearly at, well, compared to where we were in September, we are practically flat. But yes, on a year-over-year basis, we are still down 40%. So this chart actually goes to September. Remember, we had new lockdown measures that were announced. So basically, we had a huge collapse in December and January, and we are recovering back to the flat level where we were in September. I believe this chart will finally inflect positively. Moreover, and this is all the airlines, and this is going all the way back to 2019. Notice the improvement in the website visits for every airline. This is Delta, this is American Airline, this is United, and take a look at what's happening in Southwest. Right over here. This is the trailing 7-day growth in the daily visits to southwest.com. Southwest is performing the best among all of them. If you zoom into the Southwest chart, this is what it looks like. This is going back all the way. This is the actual 7-day growth in the daily visits to southwest.com. We are practically back to 0% line before the pandemic. And naturally, there's going to be conversions rising because people just don't like to visit the airline website. So if the visitations are rising, chances are that's also converting into revenues, more ticket sales, higher prices, and all of that. The point of all of this is that so far, this travel or leisure theme that we laid out in early January with recommendation to buy call options in Southwest Airlines is panning out exactly as we thought. And clients who have been patient, have been trading call options in airlines, have been rewarded nicely. And Southwest wasn't the only one. We followed up with this note to recommend call options in Boeing. We also recommended call options in United Airlines. And then we have in the chat room, we discussed call option buying in American Airlines and also Embraer ERJ. Also, going back to the Southwest Airline chart, if you look at the long-term weekly chart to get some perspective, here is the 5-year weekly chart of Southwest Airlines. I believe that as the travel continues to improve and we sort of overshoot to the upside because as vaccines get distributed, there's going to be a pent-up demand that will come back. If you look at the long-term 5-year chart of Southwest Airlines, I believe this thing is going to take out all of this resistance level that are between 60 to 65 levels. This is a 5-year chart in front of you. You can see multiple times as the stock failed a couple of years ago or around this level. It may pause there, consolidate over here, but I believe with the pent-up demand that's coming up, there's going to be a setup here for this to take out all of those resistance level from a few years ago and make a run towards $70 to $75 per share. Here is the long term. This is a 15-year monthly chart with monthly candles of Southwest Airlines to give you some perspective. Naturally, this is possible that we're going to see the momentum slow down just a tad because a lot has been baked into this stock, but the path of least resistance, in my opinion, is still higher. And I believe over time, the stock is heading to $70 per share. So I just wanted to provide some color on one of the trades that we had discussed in webinar in early January and how it's performing and how the data is looking in front of us right now. That's it from me. Let's go to Jay.
Morning, everyone. So a couple quick mentions on the consumer side today. Stock number one is J&J Snack Foods. Ticker on that one is JJSF. This is a nearly $3 billion snack food and beverage company.
JJFS?
SF, Sam Frank.
SF, okay.
Their main segment is food service, and that makes up 70% of total sales. The primary products sold under this segment include soft pretzels, frozen juice, treats and desserts, churros, funnel cakes. And the customers that it includes, fast food outlets, stadiums, sports arenas, theme parks, movie theaters, warehouse club stores, colleges. In the prior quarter, sales for this segment were down 13% versus a decline of 21% in the prior quarter. And if you take a look at today's first read, in the consumer section, we highlight news out of California, highlighting how they're going to start reopening theme parks, sports stadiums, not at full capacity, but nonetheless reopening them. So I think this is just a sneaky way to play the reopening theme with regards to movie theaters, theme parks, and sports stadiums.
You know, in early January, and I'm just giving an example of what I'm seeing here in my state of Michigan. In early January, there was the governor Whitmer, who is one of the strictest governors, I think, in the entire country when it comes to trying to curb the crisis, COVID crisis. She opened all the recreational facilities, such as sports arenas, as well as the ice skating rink where my daughter goes. But no attendance was allowed inside, but kids could go and actually play. A couple of weeks later, she followed in late January, and she said, "Okay, now parents can also go inside. We're opening all of this, but masks are still required." In early February, she told all the restaurants, "Okay, so now you can start reopening the indoor dining." You know, it was only outdoor dining was open up until that time. But in early February, she said you can start reopening the indoor dining with 25% capacity. And last week she said, okay, now you can open 50% capacity, and we will revisit the caseload again within a couple of weeks. And similarly, there have been other actions taken with slowly, gradually reopening. Governor of New York, Cuomo, announced, I believe it was also last week, that you can open outside of New York City, outside of the parameters of New York City, so Manhattan Island, I guess. You can open restaurants now at 75% capacity. He was at 25% up until 2 weeks ago. I think the data is all in front of us, and there's so much of it across the board. You saw that the governor of Texas and Mississippi have now taken the mandate down for the masks. The things are reopening, and stocks like this, particularly in the food category and the restaurant category, should continue to see improving trends for several months to come.
Definitely. And then the second stock is Ulta Beauty. So they're going to be reporting their earnings this Thursday after the close. So I have a few days to possibly do a preview, maybe post that on the homepage. But anyway, Oppenheimer was out last week with a note. First of all, just highlighting how Kohl's revealed their initial 200 locations that will be receiving the Sephora store within store concept. And Oppenheimer did their analysis and saw that there's meaningful overlap with Ulta locations. So they view that partnership, the Kohl's Sephora, as a negative to Ulta. However, Ulta has their own partnership coming out, I believe, in the fall with Target. The same, store within store concept. So we're probably going to hear more about that on the earnings call. But Oppenheimer did actually mention that both the Ulta and Sephora partnerships are a positive for Estee Lauder, ticker EL. We haven't actually covered that name in a while, but possibly one to revisit. And then in terms of comp sales, ultimately Ulta is still a brick and mortar retailer. So I know Oppenheimer has a 10% decline in comp sales, as well as UBS. But these comp sales are going to be easier, for Q1, for Q2 due to COVID. But anyway, like company is going to be reporting this Thursday, and I might do a homepage write-up, a preview for that. So stay tuned for that.
Sounds good. One of my favorite names in the retail space, naturally, Ulta Beauty, very well-run company, strong management, and the way they handled uh, the COVID-led slowdown, it was remarkable. So it should be beneficiary of continued strong trends here as well. A lot of the times, if you can just bank on strong management to drive your portfolio, you can come out doing just fine. And this is one of those companies that has done quite well. Read a lot every time when I read their earnings report. It's always fascinating to read to watch management discuss how they're doing things, how they're managing inventory levels, and every single thing. They did not rush in the early phase of the growth to build out a whole bunch of stores. They maintained their charm. They said, okay, we're going to be very prudent about this. There's just so many little things about this management that just shines when you read the earnings report each time. So this should be a good winner in the long term. Right, good stuff. All right. Chronicle, was that everything, Jay?
Yeah, that was everything.
Okay. Chronicle, I saw on the first read this Coursera. Coursera, online education provider of courses such as machine learning, cloud computing, language, and all of this by more than 3,700 universities. It's finally coming to the market pretty soon with an IPO. It took them a long time. Many years ago, literally it was 5 years ago, I had first mentioned that this company should do an IPO. This should be a good winner. And they should have done it last year during the pandemic, because I would imagine that their business actually took off with the university being closed. But this is in a lot of ways, this is a disruptor for universities and colleges. And I just a couple of weeks ago too, I had one client asking me, is like, hey, have you heard anything whether Coursera is going to be doing an IPO soon? So we have to watch this one carefully. Now that I see the news, see when the IPO comes out, where they price it at on the valuation side, and how it's going to perform going forward from here. It's an interesting company. I have used some of their services. I know Tom has used some of their services in the past as well, many years ago. So one to watch. Just wanted to get that out of the way. All right.
So I have a quick update on AirCap today, ticker AER. If we remember, this bull case was laid out for the company in our morning conversation back on December 28th, in which I said all the airlines with impaired balance sheets are going to have to turn to leasing solutions to meet the accelerated reopening demand instead of buying new planes. Since then, it's taken a while, but the stock's finally been working in recent weeks while the NASDAQ has been correcting. Now, overnight, this piece of news came out from the Wall Street Journal about the company being close to a $30 billion deal to combine with General Electric's own aircraft leasing unit known as GE Capital Aviation Services. Now, the thing is, the full details behind this rumored deal are still a bit lacking at this moment in time. So if anybody is currently in the stock, just be aware that the situation is going to be very fluid. For example, if it turns out that AirCap is the one that's buying GE's air leasing unit for the full $30 billion plus dollars, then that's likely going to be extremely dilutive. But on the other hand, if both parties are striking some sort of favorable deal where GE is dumping its assets at a discount because their management wants to strip the company down at any cost, then I think that's going to be incredibly positive, even if it ends up being a cash and stock deal. So we don't have all the information yet. Therefore, it's something to keep an eye on. Looking at GE's fleet, I think the wide and narrow bodies are going to complement AirCap's portfolio nicely, even if the freighters may end up slightly increasing the average age.
Yep. Excellent timing on this one as well. AER, December 28th. The bull case was presented in the conversations that day. We hadn't touched this stock until this one was brought up first time, and we mentioned specifically that we're opening a new position in AirCap as the research is pointing out to increasing leasing activity for planes at a time when airline companies remain financially distressed and look for alternatives. This is one of those out of box thinkings that was so right on the money because, for example, just last week, United Airlines is still in the market raising cash, their capital. This morning, American Airlines is announcing that they're, I believe, $2.5 billion in convertible bond offering. So there have been series of news that all the major airlines in the US continue to boost the liquidity on their balance sheet by doing debt offering or share offering, which because their free cash flow position still largely remains negative, although it's improving. So as the economy reopens, instead of buying bulk amounts of large new planes from Boeing or Airbus, they're resorting to just leasing them. And this is where AirCap comes into play. This is a trend that still has some tailwinds, I believe, and it's going to continue for a couple more months before the economy has recovered to the point where the order book for new planes start to go up. And naturally, then AirCap itself is also large buyer of new planes from Boeing. So it all trickles down to basically at the all the way down to the OEM level. This was fantastic, right on the money on December 28th, and you can see how stock has remarkably performed since then. And if you look at pre-market, this thing is going to gap higher by about 12% with the deal with the General Electric. So there you have it. Excellent stuff. All right, folks, we're going to stop over here. This market's still on the edge. Garden variety of chop fest continues to take place, but I believe this is how the bottoming formations look, happens in the market, and gradually a new firm trend will appear in the S&P from here with a grind higher back to new 52-week high. That's it from us. We'll see you in the chat room shortly.